guys, it is Markets with May. It is March 22nd, and we are coming to the end of the month. There's like 2 weeks left. It is crazy how much this market is just doing its own thing, trucking along. I want to show you guys. This is FinViz. Most of the market is green. Some of the market is not green. It looks almost like a complete just reversal. And I think, here, wait, actually, I want to show this first. Yeah, finance. So we've got all of the indices up and crude down, even though it started up on the day. And these movements are so small because you think like crude was up so much and just giving this little bit back. But let's call it what it is. I think after yesterday, even though we were primarily talking about agriculture, I don't see a way that you can feel like we got plenty of oil out there. I mean, it'll be interesting to see how production comes on. But as we've talked about in the past, we are kind of in the dead zone of information flow, and we also need the two big things that would impact the commodities market, which is Mother Nature and these companies letting us know what they actually did this quarter and how it went on trying to increase capacity. We have some unknowns there. Now, some are more known and some are less known, so we will go through that. During these kinds of periods of quietness, if you will, I always like to remind people that there's always an ability to just kind of reflect. So this is the one-day performance off of FinViz. I'm a fan. I got to figure out a way to work with them more directly. I emailed them. They were really sweet, and they were like, thank you. I don't know what you want us to do about that other than say, you're awesome for showing us. But anyways, I will continue showing them because they do add a lot of value. And you can see on the day-to-day, this is what it's got. But this is a good time to kind of reflect and see what the markets have been doing more generally. And the one-week performance, we can kind of see that this was a very bullish week. So a lot of the downside that we'd seen, made a lot of that back. But if we go to 1 month, it's a much more mixed picture. And I really want you to look at this 1 month because you can see how intense oil and gas has been doing relative to other parts. And then you've got really big cap stocks. I'm not a fan of Amazon, but here in the quiet period, it just seems to me like there are a lot of people that are just trying to bid this thing up. Dave, I think you sent me a shot for folks that are our subscribers. They got an alert on Amazon today. Do you want to just do a quick 2 seconds on what you guys are seeing on the technical side on Amazon?
I did not receive
I
an
think
alert.
the alert. It was an alert that was just saying there is a heads up that some folks are thinking this might actually go to 3,400. Did I misunderstand the alert?
Yeah, 3410 is the ATR this week,
Oh,
which should be a low from 3190 to 220 over that.
I see. Okay. And how do we think about that?
Well, I think, overall it's a sell, but just be patient. We'll
Yeah,
buy puts when it hits 3410 because it's
that's
got
how I'm thinking about it too.
a double top up there.
Yeah, it's so weird. I mean, like, there's no news flow on Amazon. There's like nothing that's going to come out in this week, anyways, that's really going to help them or hurt them. And then obviously you've got the rising oil price as relates to that, and you've got massive inflation. So it's kind of a funky time period. There's no great reason for it to be up. There are reasons for it to be down, but I'm not going to. But given what I think, the way that even I would interpret this on the fundamental side, even though technicals is not my thing, is you just have so much strong momentum coming in to buy this market that it almost doesn't matter on the reversals. But if you go back out a month, you can kind of see that certain sectors that are a little less at risk or even benefit from the issues in the Ukraine are doing ever so slightly better than other sectors or segments. The cards still have a lot of room to try to correct. As you guys know, I kind of have lightened up on any short positions in the financials on the credit side, simply because, especially for something like PayPal, I don't know what the street did on their estimates as relates to whether or not they fully baked in any kind of international transactional costs or international transactional fee revenue. So it's possible that just cosmetically makes PayPal's story look a little better than it probably is right now, to be fair. So I've gotten out of that when it was at 100, and I probably won't play it until earnings comes out, even because I just kind of want to see what happens here Um, there's a lot of bullish sentiment on the banks for some reason. It doesn't necessarily match the banks that are doing well, but I will give you something a little more fleshed out. All of the banks are in the quiet period right now, so you will hear analysts kind of making their bets in front of earnings. The banks, JP Morgan in particular, is usually the first grouping, if you will, to come out, and that will be next month on the 12th. So they're definitely in the quiet period right now. And then, healthcare on the month is done quite well for good reason. Those guys, especially to the extent that they gotten clobbered because of the COVID momentum trade, many of them have great stuff in the pipeline. And also, um, the COVID number is actually completely split out and you still see like 20+% growth off of something that might have like a single digit multiple. Pfizer is one of those. Moderna is one of those, although the pipeline is a little bit I mean, they've got a bunch in stage 3, but it is a riskier pipeline because they are such a young company. So you kind of want to see them crest through some of these drugs. But in fairness, it was quite cheap when as it was rallying this month. And then you are seeing a lot of the companies that are dependent on commodity prices, like the restaurants, things like that. And that just has to do with the fact that, like we heard yesterday, um, you really want to find your spots in these because food prices are going up. I mean, unless Mother Nature really helps us out a lot somehow magically, and somehow there are some things on the fertilizer side that just somehow magically subside, these guys are going to have a tough time with things, the restaurants in particular. I do think there's always a price at which, even with that inflation, these guys are cheap because they are good businesses. The U.S. is in a strong position of strength right now. So I am essentially on days like this just watching to see what price points might start to become interesting. And again, that's really the overarching strategy that I would take. I also want you guys to kind of look at this world map. China is in fuego today. And I'm going to go through again because, we had been very bearish China, and we always talk about it because I know, David, you're always long Didi. I do want to talk about this a little bit more because I'm seeing people report different things and the social media is different things. I do think the structures are complicated. Europe continues to make me very confused because they absolutely were not prepared for the war and conflicts that's going on right now. They, like, across the board, these guys are going to experience inflation in a way that they did not experience it previously. And then Latin America, as we've been mentioning, very bullish on, is green. It's very mixed today, which tells me there's no one really coming in here and aggressively making a stand in this marketplace. Okay, so that's what I like to kind of see the picture of how bullish was today. Is it a reversal? What's actually going on? And that's why I oftentimes like FinViz, because then you have to do the data work yourself. Um, you know, Close enough for government work, in other words. But I would say that even though this is a green day, I would still expect it to be choppy because there's no real cause that's driving this. And then there's still a lot of things that are absolutely potentially going to cause concern. Now, whether this persists for 1 day or 2 days, this kind of back and forth, we always want to look at the VIX and see if there's a way for us to hedge out. The VIX is trading. I think it's not going to let me look at it, but I think when I looked at it right before I came on here, around 22, 23, something like that. If the VIX tries to kiss below 20, that's probably when I'm going to start to be interested in just using longer dated VIX as a hedge for myself. There's a few different ways to buy it, but because today isn't necessarily the day that you would pile in, I might wait one more day. We'll watch it tomorrow very closely because, like I said, like we know, we've said in a couple episodes, next week for this week's economic news, it's really about. Oh my goodness, I think I've got the wrong one. Here we go. Sorry about that, guys. 1 second, I'm going to stop share because I have the wrong deck open. Sorry. It's really about the news that comes later in the week on Thursday. That's where we're really going to be looking to see what potential concerns could be out there in the marketplace, and that's really the purchasing managers and some of the industrial data that will tell us. Here we go. That will tell us who and what and where and why, as far as whether or not folks are going to take a breather and not necessarily participate in this crazy pricing that we've been getting. My suspicion, though, is that there's a chance either way, on the durable goods orders and on capital goods orders, and PMI. And this is going to be because my suspicion is, these really represent the buying decisions of manufacturers, and knowing that there's this conflict gives a different reason than you would have had in months previous for why you might have wanted to just give it a half a beat on and see where inflation comes out. So we'll be looking for that. I also think the current account deficit will probably be, typically this is not a number that people watch like a hawk, but this month may just be a little different. So look for Thursday. Don't be too aggressive on anything you're doing. Kind of chill, and then kind of got to see what happens on Thursday to see where things go. Now, a lot of people are coming out and talking about the ADRs. And what I really want to do is make sure that you guys, and I'll probably be working between these two because apparently the thing with the ADRs, a lot of folks are saying it's no big deal between the two. You can just trade them as if they're identical to each other. And I'm not sure why they would say it that way, but they are saying that way. And as you guys know, I have been a little bit more sensitive to the idea that you've got this VIE structure. But what I did was I posted something a little more comprehensive. I finally found the paper that I'd reviewed a million years ago from 2017. And it's this paper that really discusses the VIE structure. And I think what people, the weakness that we saw earlier in the week with all the things going on in China and some of the escalation of antagonism that we were hearing, then you had coronavirus on top, or an outbreak of Omicron in China, kind of making things a bit weak as well. There are kind of two dynamics going on here. At first, there's the VIE structure, which has its own special sauce, let's call it. And then there's the transmission mechanism between the ADR and the ordinaries. And I prefer that people not be in the ADRs if they can help it, and be in the ordinaries. The thing is, in this kind of market, when things are a little bit too weird like this, what'll happen is there are folks that trade the ADR and the ord and try to keep those two things pari passu, meaning identically priced. And this is what you would need math-wise to do it. Like if you own the ADR for a lot of the ADRs, including BABA, that sort of thing, you can absolutely pay these conversion fees and just have it swapped in to the ordinary. And it's this math plus any kind of FX rate that's doing some sort of volatility that actually goes into making sure that the price between these two things is always stable. But if you have a lot of pressure in the US, it should hit the ADR as a function of the fact that these two things should be equivalent. Similarly, if you have a lot of buying of the ordinary, it should impact the ADR to the extent that there's not another dynamic going on. I want you guys that really care about this to go and look at this paper that's on the Discord if you're one of my subscribers, because the VIE structure, some folks are like, it's totally fine, it's totally safe. Other people, I think, just don't know what to say about it, and so they say a bunch of gobbledygook, and that is what it is. But I think if you are investing in it, then you should understand where it could be a problem, where it couldn't be. There are absolutely examples of stocks that have gone wholesale to zero because of the ADR. DD, which I think will trade around for a while because of its delisting, it will be very interesting to see what, if anything, DD does for shareholders. It technically doesn't have to do anything, and there's lots of precedents of that happening that this paper will go through. Whether or not it decides to do nothing or whether something else happens is another story. As a result, I kind of watch these very closely for where to go in. And usually if I'm going to go in, it has more to do with valuation uncertainty than it does this mechanical thing. I'm actually trying to stay away from the mechanical thing. Although with DD, if it gets too hot, sorry, Dave, but I probably will find a place to just buy puts on it, because ultimately that thing is going to come delisted, and it's just whether or not they're going to tell us what they do associated with it. um, and whether or not that's going to work for shareholders or not. But it is absolutely, if they do it, it's just because they're doing it to be nice, not because by law, according to the VIE structure, they don't really have to do anything. And that's what bothers me. The last thing I'm really going to, the other area I kind of want to review at all times is the semiconductor space because it got clobbered so aggressively. If we look at this map, you can see kind of where semiconductors even today is not, or in the 1 month is still down. Other areas are not down nearly as much. Today you're getting a bit of a rally. In general, the news flow on the semis has been a complete confusion to me because these companies report, top line growth 20-30% margin expansion, so you're getting like operating income growth in the high 30s, even 40s and 50s in some cases, and they just get completely puked out and clobbered by the marketplace such that they trade at like a 15 multiple or even lower. The semis make no sense to me on valuation. I really think that there's just some kind of massive confusion about the fact that there's so much supply coming on with the foundries and the such. That's the closest thing I can find. That makes absolutely no sense given how bad the shortage is and all the number of things that the semiconductors will go into in order to move us forward. Like you can't have a world where you believe we are all going into the metaverse and somehow also believe that semiconductors are short. It's like literally you're believing the opposite thing. It's it's a massive cognitive dissonance. So from time to time, the semis still barely getting back to even what I would call significantly undervalued. You should take a look and see if there's a price where you'd like to buy and hold them. This again is the strategic reason for why the U.S. in particular is subsidizing in many ways the building of these foundries. Now, in fairness, these companies all have plenty of money, so it's not like they're using zero for capex, but it is very profitable for them to use those benefits to improve their circumstances as far as bringing it back onshore. The last thing I'm going to mention is there are very few companies reporting earnings, but we do have General Mills reporting earnings tomorrow. Now, General Mills, you know that we've been short Kellogg, and we've been short Kellogg even though it trades at like 15, 16 times because it really had to deal most of last year with the union issue and a number of other issues. And I'm not convinced that given all of that, that they will be able to have this magical ability to offset a very aggressive grain market pricing that we've been seeing. And as I've mentioned, one of the things that we'll be looking for as we move through this quiet period of the next month to next month is finding places on rallies of companies that clearly don't have their supply chain under control. Some do, others absolutely do not. Tomorrow, we're going to get a data point to understand if it's already started to be a real problem for so many of the staples from Kellogg. Now, or sorry, from General Mills. Now, General Mills last quarter, they had only the most basically tiny problem relative to Kellogg and definitely relative to other staples companies. So I want to see if they were doing a great job with pricing, which they said they were going to do, and also with getting getting pricing through, but also being able to manage the supply chain. This will be very telling. It is the case that because if you are long General Mill or you already have a position in General Mills, I want to mention that you can always use a stock that is similar, such as Kellogg. That's why I'm actually looking into this because I want to see if it affects anything that I'm long or short and how I might want to position. And in fact, the volatility in staples is really low. It's 22%. Sometimes this can drop down to 10%, but from an options perspective, if you've got a position on at 22, this is really for single name, that's still pretty low. So you can hedge it out if you need to. I want to show you one thing that you want to always look at, and that's correlation. That's if you're ever thinking to do this. I have done this before. At the beginning of the quarter, we talked about Netflix and Disney and the correlation. Oh shoot, I lost my little thing. Sorry. There are correlation calculators out there. Let me see if I can find one. Let me stop the share. There are correlation calculators out there. And what correlation is it's a mathematical calculation that lets you know if two stocks are similar to each other. And as we kind of saw last quarter, we saw that Disney like, Netflix did something, so then Disney did something. Other ways to think about correlation is that, sometimes you'll see all of an industry move up together, that sort of thing. Okay, let me share the screen again. You can absolutely get these correlation calculators off the web. And that's a really nice thing. The math isn't really hard, to be honest with you, especially if you've got Excel or anything, Google Sheets or whatever. But the data is a real pain sometimes. So that's why I prefer to do it that way. But usually what you want to do is you want to move it to daily returns unless your time period is something really, really special. But if you're under a year, in my opinion, you really should be using daily returns. And then it'll calculate it for you. And I swear this isn't any kind of special calculation. And it'll give you a number. And this number, I think the way that they're doing it must correct for some things, because if you go to the rolling correlation, you'll see a chart like this. And because there are so many different ways to calculate correlation, and this company isn't specifying precisely which correlation calculation they're doing, some of you would be like, what do you mean? But you could technically be adjusting for different things in the data, so to speak. And in some cases, I don't think you should, but that's a different math nerd discussion. You can kind of see that from time to time, these things do not trade together. But right now, and I think this is because of what's going on with corn, these things are in fact trading together, such that you have a fairly high correlation between the two. Anyways, what that indicates to me is that if you were long Kellogg in any way, shape, or form, or short Kellogg, whichever it is, and you were a little worried about going about General Mills tomorrow, you could absolutely use them interchangeably as a hedge for just this shortened period of time. Vice versa, if you just wanted to play General Mills like a lottery ticket, you might be better off going into Kellogg. And there you could do strangles, and the strangles that you might want to do as a lottery ticket is 45 cents. It's not the world's cheapest, because that's still, 45 cents divided by 57.50, so you get a sense, or divided by 60, so you get a sense for what you're paying per share. But you could buy the 57 and a halves and buy the 65s, so long the strangle, and just see what happens. Because I do think that given where wheat and grain prices are, it's a real, since largely speaking, neither General Mills nor Kellogg have really moved much, but the wheat price sure has moved a lot. This may not have been baked into the stock yet. Anyways, with that, I will go ahead and hit the pause button. Are there any questions? It's very long-winded. I apologize, guys.
When does Kellogg's report?
Well, Kellogg's already reported. It's General Mills. See, I should have just written it better. General Mills reports tomorrow. It's my understanding.
Okay,
You seen
cool.
something different?
Okay. No. Didi.
I know, Dee Dee.
I've read where they're trying to do a dual listing in Hong Kong and
In
here.
Hong Kong, yeah. It's a
dual
smart
listing.
move.
It's a smart move because, the arbitrage opportunity alone will help both exchanges.
Yeah, it's that really weird dynamic between the two that does, oh my goodness, I right this minute is a tough time in the ADR VIE. Right this time is a really odd time in Chinese stocks. Let's call it that way. I've, with limited resolution on how China is thinking about things right now, I do think I'd like to see another month for me from a risk perspective, because my term is very short in nature. If you could buy the ordinaries in any Chinese stock, then that I kind of understand. Absorbing the volatility will be painful and unfortunate and not fun, but at least you can buy puts on it from time to time, let's call it, because right now with the vol so high, it may not even make sense to do it that way. It really comes down to the fact that one of the things that I think oftentimes gets forgotten is that of the things that China does not like, okay, it does not like anyone. It does not like to have anyone have power over its economy other than itself. Let me say it that way, right? It is more than average sensitive to that relative to other countries. And I oftentimes think people forget all the things that it's done in its history and what kind of history in general makes it feel that way, right? So, like, um, it, unlike some other countries that came out of World War II, was incredibly sensitive because of what it experienced from 1800 forward to this idea of economic control over the nation and how disruptive and disturbing that can be. As a result, this is the actual timeline or some highlights of the timeline. I'm sure somebody else will draw a different timeline for you of when and how China has opened its markets subsequent to Deng Xiaoping having rulership over, post Mao, the post Mao era. Um, and you got to think, this is really slow, right? India, you know, long time you've been able to invest. There aren't a lot of Indian ADRs, but there are a few. But other countries in Latin America, tons of ADRs, right? Canada, tons of ADRs. China, you got a lot of ADRs, but not relative to the number of companies that, in theory, you'd think would want to, given how much their market caps would be. And there's a reason for that. Um, and it's still unclear to me, given what has just happened and how particularly this war has already evolved in the first few months, what China is going to do to make sure that no one can play with its capital markets. Let me say it that way. Um, that's why I think until we get another month of stabilization and these stocks not behaving too crazy, it might be, from a risk perspective, a little bit safer. I don't know if that makes sense.
Yeah,
It's not,
thank
look,
you.
if you're a day trader, I think this is going to be the most fun market to be in at all times. If you're a day trader, knock yourself out. It's going to be really fun. But yeah,
But I think China also has a big concern with security and the
yeah.
but they can silo the Chinese data versus the US data. And the US has concerns too, but they can make it where you can't see it if you're in the US, what's going on in China. In other words, where people are taking trips, blah blah blah. If it's a government official, you they can silo that where it's not a security risk.
Okay, that's definitely specific to Didi. I'm talking about the whole capital markets itself. Like, it took a long time for China to be like, okay, we're cool with having you guys list in the US. You know what I'm saying? Like, that VIE structure was absolutely created to circumvent the restrictions that China had put originally on any company listing outside of China. That's why it took so long for so many of the really big companies to come out and why they came out at such ridiculous market caps, right? So in that paper, if it's something that's interesting to you, and I know sometimes you represent a whole bunch of people as well in the work that you're doing, it's something to just really truly understand this whole um, the reason the VIE structure exists was to circumvent, not to, like, the China was super cool with it. It was to circumvent the Chinese government so that you could list in the United States, have access to foreign capital. China just happened to be like, you know what? Let's just see how this goes. And then if we really need to crack down, we can, because we're China and you're in China. And so I can just take your company away if that's what you wish for me to do. So that the fact that they've had a couple periods where they've done some things, right? And the way they do it is they seize your assets domestically until you do a certain series of things, and the stocks tank when they do it. It's described better within that paper than I will articulate it company by company. So the way that China does it is very particular, but nonetheless, that's the issue with that particular structure. And in some cases, what's ultimately happened is, investors have taken a loss, the company still residually exists, and they find a way to merge it into a company that is not listed, and then the ticker disappears. Something like that. So there's a few different ways that this gets resolved, none of which are very straightforward, and all of which really deal with more that issue. With DD, you got another layer. That's for sure. That's for real. That is a real thing, and it is a true thing. China was really unhappy with the type of data that DD takes in and what might result to the extent that you have foreign investors. But over the entire market, my real issue has to do with how do you think about the fact that we just sanctioned Russia in a particular way as a and it clobbered both their stock and their currency and a number of other things. And how's China going to feel like that about that? as relates to the 50-year plan that they had to open up their markets to become more global. Their beef really isn't with the entirety of the global markets, by the way. It's really with us in the United States. And so we didn't, I think it's something that maybe the market's still trying to understand for some reason. Although I think it's pretty clear to Chinese people, strangely enough. Did that make sense?
Yeah, yeah, sure. I get it. I
Um,
just don't. There's no way we would ever sanction China. I don't think.
Oh no, we would never sanction China. I don't think it'll be about whether or not we sanction China. It'll be about how China feels in general about the whole situation and what it wants to do to just ensure that it's not. Do you know what I mean? Like we set off an economic nuclear bomb on Russia, the equivalent of, right? China, you
Well,
got to believe that there's some Chinese people being like, all right, what if they did this to us? How would we react and what would we do? And at least that's what, like, I don't know. I'm just a retail investor hanging out here in New York, but, watching it, that's what it probably looks like. Now, from then, maybe it's already been resolved, and that's why the markets are correcting. I just want another couple, like, I want another couple weeks or something to watch for it before I decide to go long or short this market. Like in China. But like I said, this could be a really fun day traders market because it wouldn't take much one way or the other for it to continue to flit around. The fact is, if I'm just going purely on valuation, yes, I 100% agree with everybody. Most of the Chinese stocks, even though in some cases the economy of China may not be as rosy as everybody sometimes feels it is still a hugely growing market. And some of these companies, they're going to be around for a very long time doing amazing, amazing top line growth, bottom line growth, and cash flow back to investors. So I 100% agree with all that. It's just this one thing, which is what is China going to do as a countermeasure to what they just saw? That I don't know the answer to yet, and we might not get an answer to it, and they might do nothing except have provisions that are slowly announced over the course of months.
yeah, DD. I mean, it's $4.10. I mean, if it goes
Yeah,
to zero, you lose $4. I don't know. That just seems like a good risk reward to me.
yeah.
There's
I mean, if they list on the ordinary, if they list the ordinaries in Hong Kong, it'll be interesting to see. Um, I'm not sure. My understanding from what you told me before was that they've already begun the delisting process in the United States. So is it just that they're, I mean, my suspicion would be that they would list the ordinary so people could do the ETF transaction. Or I'm sorry, they could do that transfer stuff that I showed you on that slide and then
um,
just all be in the ord or sell out.
yeah, that's been reported, but of course they can change their mind. I don't think they
No, I
want
mean,
to.
I think if they're listed in Hong Kong, then that solves the issue for the Chinese government for sure. And then you would just try to trade your shares out for ordinary shares, probably.
Right,
Yeah.
but I read where they would do a dual listing possibly.
I mean, if they've already delisted, if they've already started the process of delisting, they've already started the process of delisting, I guess.
That takes a
You know
couple
what?
of
Let me read what it is you're seeing. I probably am just speaking off of a cuff, but my generalized feeling is that if they've already started the process of delisting, then they're probably going to delist. And what they're doing is giving investors a way to transfer shares from ordinary to ADR or ADR to ordinary. I mean, if it's I don't know how long it takes or how long it will specifically take DD. I think it can sometimes take years to delist depending on what's going on, or it can be very quick. But um, you know, that gives time for the investor to kind of transfer their shares.
right. Okay.
I mean, it's an elegant solution to the thing, um, and it should hold the price of the stock, and then the ticker would disappear one day.
Okay. Thank you, May.
Cool. Any other questions? All right, it's a short day, anyways. Good luck, guys, in that marketplace. It's so weird.